Hi and Assalamualaikum. My name is Siti Aisyah binti Ibrahim Ramsa and my matrix number is 06D8023F1034. Now,
hi, my name is Dilosha Sri Rajendra. My matrix number is 06D8023F1147.
My name is Muhammad Nur Aziz bin Nuritan and my matrix number is 06D8023F1062.
Hi and Assalamualaikum warahmatullahi wabarakatuh. My name is Nurfara Kalisa binti Subir and my matrix number is 06D8023F1046.
Hi, my name is Tanisha Anna Perempuan Gunasegara. My matrix number is 06D8023F1031.
And now I want to present about the nature of current liability. So, what are the definition of current liability? Current liability are company short-term financial obligations. Current liabilities are listed on the balance sheet under liability section and paid our revenue generated by the operating activities of company. Based on MFRS 101, requires a liability to be classified as current. Typically, one entity does not have an unconditional right to defer settlement for at least 12 months after the reporting period. The right to defer settlement of liability is rarely unconditional because most loan arrangement contains conditions or covenants that the borrower must meet in order to continue deferring settlement beyond 12 months. Now, I want to explain about example of current liabilities. Number 1, accrued expenses. Expenses that a business incurs but has not paid yet. Number 2, tax payable. Tax that a business is obligated to pay based on the profit it has earned but has not yet paid. Number 3, short-term debt. Short-term debt is a financial obligation that must be paid. Dividend payables. Dividend that a company's board of directors has declared to be payable to its shareholders. Number 5, bills payable. Physical records of the amount owing for any product or services that a company buys on credit. Number 6, and the last one, is bank overdraft. Happens when individual's bank account balance goes down to below zero.
Payable process including documents involve the flowchart of the process. The slide explains the step-by-step flow of the accounts payable process. First, the process starts when the company sends a purchase order to the supplier. After that, the company receives the goods or services from the supplier. Third, then the supplier sends a invoice for payment. Fourth, at this stage, the company performs a two-way or three-way matching process. A two-way matching compares the purchase order and invoice, while three-way matching is also including receiving report. The step is very important to confirm that what was ordered or received and billed are consistent. Fifth, once verified, the invoice is coded, meaning is assigned to correct accountant in accounting system. Sixth, next, the invoice is approved by management to ensure it's a valid. Seventh, the invoice is then submitted for payment either through bank transfer, check or other payment methods. 8. Finally, the company records the transaction in the accounts payable, ledger, and financial statement. The systematic process reduces the risk of the error and ensure account payable report. Account payable is literally process that involves proper documents, a clear flow of steps, and strong control of ensure accuracy. The slide shows the three key documents used in the accounts payable process. First, purchase order. This is created by the company and sent to the supplier to formally request goods or services. It contains details such as the type of item, quantity, and agreed price. The purchase order helps control the ordering process and ensure approval before committing to the purchase. Second, invoice. Once the supplier delivers the goods or service, they issues an invoice. The invoice is a request for payment and includes details like the supplier's name, the items provided, the total amount due, and payment terms. Third, receipt. This is proof that the company has received the goods and services. It helps verify that the supplier delivered what was ordered and supports to recording of transaction in accounting. Together, those documents form the basis of proper record. Okay, let's look at the audit addition related to the account current liability. Audit additions are claims made by management that auditors test when reviewing financial statements. First, completeness. This means that all liabilities that should be recorded are actually included in the financial statement. For example, even a supplier has delivered goods but not yet sent an invoice, the company must still record the expenses. It's proven understanding liabilities. Second, assistance. This means that the liability records in the financial statements are real and supported by evidence. For example, account payable should be backed up with the actual supplier invoice or purchase order. This proven record fake or duplicate liabilities. Okay. By testing those additions, auditors can ensure that accounts payable are fairly proven presented and reliable in the financial statement. Understanding an account current liability helps company maintain financially accurate, build trust with.
Continuing from my team member, I will talk about audit assertion. The third audit assertion is valuation. Valuation is used to verify that the current liabilities are recorded at the appropriate amount and any adjustment necessary are made. For example, auditor can check the financial statement to see if it is made with legitimate information and marked correctly with appropriate amount. For example, the company can check if the electric bill is accrued, which needs to be recognized in the current liability. Next, the fourth audit assertion is accuracy. Current liabilities are recorded in the correct amount and period. For example, auditor verifies that the amount recorded match with the information provided. The company needs to check to see if the trade payable amount is the same with the purchase invoice provided. The last audit assertion is presentation and disclosure. The explanation is that the presentation is properly described and classified in the statement of financial position. For example, auditor consult financial statement notes to determine if the financial statement is properly following the accounting standard that is set. I will talk about accounting treatment for current liability. There are 4 steps. The first step is initial recognition. Current liabilities are recognized when the entity has a present obligation arising from past event which usually needs to be settled with an outflow of resources, usually cash. For example, if a company buys inventory from a supplier in August, the company needs to recognize it in the account payable in August. After initial recognition, the next step is subsequent measurement. Liabilities are usually measured at the amount expected to be paid to settle the obligation. For example, if a company buys inventories for RM1000, the company needs to recognize the amount to be RM1000 in the account unless there is a discount until the end of the accounting year or the company has paid the liability. For the next step, step 3 is accrued liabilities. Accrued liabilities are liabilities that are incurred but not yet paid by the end of the accounting period. The company needs to recognize it for it to be matched with the related revenue, which allow the company account to be balanced. For example, if a company used electricity in October but the company received the bill in November, the company needs to recognize the electricity bill as accrued liabilities until November, which allows them to pay the bill at the expected time. The final step to the accounting treatment for current liabilities are disclosure requirements. Adequate disclosure should be made in the notes to the financial statement, which includes the nature, amount, and the maturity date of current liabilities. This allows shareholder and auditors to check if the financial statement is accurate and allow shareholder to perform assessment to see if the company is worth investing.
Today we're going to speak about accounting system and control. There are 4 accounting system and control. The first is documentation. The second is authorization. The third is reconciliation, and the last is monitoring. Let's see about documentation. Why do we need to keep documentation? It is because so we can keep in proper records for all the liabilities, such as safe invoices, receipts, and records. This is because so that you can have the proof. Next, let's see about authorization. Why do we need to have a good authorization? Is to make sure only the right people can approve new liabilities. This is why it's because to avoid mistakes. Now let's see the reconciliation. Reconciliation, we need to regularly check and compare liability records with supporting documents. Example, match the amounts in your books with actual invoices. Make sure they are correct. The last is monitoring.
The audit procedure used. So what is audit procedure? Audit procedure are the methods or techniques that auditor use to check a company's financial information. So what auditor do? First, inquiry and confirmation. Auditor will ask management and confirm with suppliers or third parties to verify the existence and terms of current liabilities. Next, recalculation. Auditors recalculate interest, tax, or other accrued liabilities to ensure accuracy and no miscalculation. Third, analytical process. Analytical procedures. Auditor compare trends or ratio to spot unusual change in current liabilities. And the last one is inspection. Auditor check original documents like supplier invoice, contract, and payment schedule to verify current liabilities. So, for example, let's say our company received a supplier invoice of RM10,000 for raw materials. The auditor will first inquire and confirm with management and the supplier about this RM10,000 liability. Then, the auditor will recalculate the amount in the invoice, including tax or discount, to check accuracy. Next, the auditor performs analytical procedure by comparing this year's supplier liabilities with last year to see if RM10,000 is reasonable Finally, the auditor will inspect the supplier invoice and related documents to ensure everything is valid. Next, the types of audit evidence obtained. Audit evidence is what they collect as proof. First, invoice and receipts used to verify the amount and terms of current liabilities. Second, external confirmation. Auditors get information directly from suppliers or creditors about outstanding balance. Then, board meeting. Auditors check meeting minutes for approvals related directly from suppliers or creditors about outstanding balance. Then, board meeting. Auditors check meeting minutes for approvals related to current liabilities to ensure proper authorization. And the last one is bank statements. Auditor review bank statements to verify payments made towards current liabilities. So, from the previous example, to support that, the auditor collect evidence such as the actual supplier invoice showing RM10,000, any external confirmation from the supplier that the balance is correct, the board's minutes if this liability was approved in a meeting, and bank statements showing payments made to supplier. So the conclusion is auditor procedure guide what we do and audit evidence support what we find. That's all from me. If you have any question, you can ask. Thank you for watching our videos.